Greenlight Capital's David Einhorn out with a new letter this hour. Leslie Picker is following the money. She joined us now with the latest. Leslie.
Hey, Melissa. Yeah, Greenlight Capital's David Einhorn revealing a more bearish portfolio posture from the first quarter that paid off in its returns. Einhorn added more index hedges and increased macro positions in credit default swaps and inflation swaps. The firm has directed its research efforts to focus primarily on short ideas. As such, Einhorn said the firm added no large additions to the long side during the quarter. The strategy paid off in the fund's performance. Greenlight returned 4.4% in Q1 compared with a 4.6% decline in the S&P 500. Einhorn devotes a considerable space in this letter to monetary policy, implying that the Fed is implementing a, quote, weak initial response that could exacerbate the problem of high inflation. He said if the Fed was serious about stopping the inflation problem, it would be as aggressive and creative in tightening as it was when it was easing. Einhorn analogized the debate around a quarter point versus a half point hike to try and figure out whether it was best to clear a foot of snow with a soup ladle or an ice cream scooper. And on the fiscal policy side, he thinks the, quote, response to high energy prices is likely to lead to even higher energy prices. Einhorn said, quote, there is some evidence that inflation is destroying demand, which is slowing the economy. Melissa, so you can see some of his bearish posture is playing out in how he feels about the macro environment right now.
Yeah, the performers in the quarter, Leslie, interesting because he got into coal, a coal name, and a copper name just before war broke out. But he only added very small positions to some other ones, a lot in sort of the transport and energy space.
That's right. So he announced the new additions included International Seaways, Ryanair Holdings, TD Synnex Corporation, and Southwestern Energy and Weatherford International. But again, these are very small positions. You can see they are some kind of play, whether directly or indirectly, on what's going on with inflation, which he kind of spells out in the letter a little bit, that he thinks there is some bullishness in names that are exposed to commodities and things that would benefit from higher energy prices and the like. So you can see that in his positioning. But interesting that the short side of the book is where he's been focused on, especially since in prior years that's been a real difficult place for any hedge fund manager to make money.
Yeah, well, when you take liquidity away, maybe it'll make this game a little easier for them. Leslie,
exactly.
Thank you. Leslie Picker. Is now the time to look for shorts in this market? Jim Lebenthal.
I don't think so. Melissa, you're probably aware that Scott calls me Mr. All In. I think, if there were a criticism of that, I would say that I've been too early, but not really, because I kind of did this at the end of February, early March. But I don't think this is a market to short. Now, I know you don't like it when I bring up my frenemy Steve Weiss. He would answer the opposite, but he's got a thesis that we're going to get down to a 14 multiple on forward earnings for the S&P 500. I just don't see that because I see earnings continuing to grow. And again, back to what I said at the beginning of the show, this is a tug of war right now between earnings growth and the Fed. The market's been pricing in the Fed for 3 months. It hasn't been pricing in earnings growth that I think is going to continue, even though we're only early in the earnings season. We've seen it already.
John, I'll ask you the same question. Do you think now is the time to look for short opportunities in this market?
No, I don't, Mel. I think Jim's been right about the market isn't just going to dismiss higher interest rates. The question is, how much higher do they go? The bond market has done a lot of work. You've talked about that, Mel, for the Fed already. The question is, are the rest of the Fed market participants on the FOMC, the voting members, are they going to be of the same mind as Mr. Bullard? I think not. And I don't even think Bullard said that it's an absolute, slam dunk that he'd be in for 75 basis points. He just said it's at least in the discussion. That doesn't mean that he thinks it's likely. So I think the bond market has already done as much as it needs to do. And then we'll see after the next Fed meeting how we shake out, Mel.